Welcome back to Great Quarter, guys. This is episode 58. We are back in the studio. I'm glad to be here. It's been about a month since we've been in the studio, so we are COVID-free in the office, and we are back here ready to roll. I'm your host, Andrew Cox. I've got Seth home with me as well. Like I said, it's episode 58. Today has already started off to be an amazing day. The greatest video game of all time is back. It's coming back. That's NCAA college football. It's coming back with a new name. It's not going to be NCAA football. It's going to be EA Sports college football. What do you make about that? I see it as they're kind of getting ahead of them, or preparing for the eventual demise of the NCAA. That's what I read.
I don't know, but I used to love that game. I haven't played it in a long time, so.
I haven't played it in probably 3 or 4 years. But it's funny. There's like this whole aftermarket for the game. Somebody got on the Twitter thread right after EA Sports had come out and announced it, and he's like, "Why couldn't you tell me this a year ago? I just spent $300 on a refurbished PlayStation 3 and a copy of the video game." It's like this huge second market just to play that game. There's huge demand. It's an amazing game. Okay, so we're gonna do You Care or Nah, but then just after we're gonna get into our main conversations of the day. We've got a couple of them. We're gonna talk about Basco Majors, a analyst at Susquehanna. He downgraded 6 trucking stocks, so we're gonna kind of talk through his analysis and where he sees the market going this year, what we see for asset and asset-light businesses. And then we may get into a conversation about the vaccine rollout and how we expect it to impact trucking if we get to it there at the end. All right, so we're going to start off You Care or Nah. So this is, of course, our gauntlet of interest. I'll give Seth a topic, idea, or an event. You tell me whether you care or not and why. So the first one is on JP's biggest holding. That's Uber. Announced this morning that it will acquire Drizzly, an alcohol delivery service, for $1.1 billion in cash and stock. Apparently, it's about to be 90% stock, 10% cash. Seth, what do you think? You care or not about this acquisition from Uber?
I don't care, but I did do some research on it because you put it in here, to be honest. But, I don't think that I was a little bit surprised by this. We were kind of talking about it. I think they're going to have some problems getting this to be a major service just around the regulatory front. However, I did watch some interviews with the CEO, and it's a big market. He was talking about on CNBC. It's a $250 billion market for, I guess that's hard liquor sales in the U.S., and it's a growing market, and it's high margin, and only 2% of that is online right now. And they see that going to 25% in 2025. And the other thing I noticed is they've got some A-list investors. Tiger Global, which is a fund that I've always followed closely, is invested in Drizzly. So it must be pretty good, although Drizzly's share of the overall online alcohol market was 10%. So it's not like Uber with ride sharing, where I think it's more like 50% or something like that. So I think I personally, as just a customer, I would love to have alcohol delivered to me. Actually, I don't know if you know, but I tried to do, I'm into wine, so I tried to get wine.com to deliver me wine, and there's limitations in Tennessee, for example. This is an example of the regulatory problems. I'm only allowed to get something like 3 cases of wine a year, and or 1 per month, whichever is less. Okay. So I couldn't do the subscription because of that.
Too much.
Wow.
Yeah, I agree. This is going to be a big headache for them. I'll say that I do care. I am interested in it. I think that Drizzly's a cool company, so I did a little research on them. So one of the ways that they've been able to get around the legality and the legal problems of delivering alcohol is they never take possession of the alcohol, so they actually don't have their own fleet of drivers. They just connect. They have a software platform that connects people that want on-demand alcohol delivered to them to local liquor stores. So the local liquor store has their own drivers that deliver this. So they never take possession of the product. Also, they don't take a percentage of sales like Uber does. So they take a flat monthly fee that they charge the liquor stores. So I just have a lot more questions after reading more about the company, because it seemed that Drizzly has done a good job of mitigating and limiting its legal risk because they never take possession. But now, are the liquor stores that can use this app, that can use Drizzly, are they going to be able to use Uber drivers as well to deliver it? And does that mean now that there's another legal headache for Uber, that they are taking possession of the alcohol? I have more questions than I do answers after this one.
Right, and that makes sense. And unfortunately I don't have the answers for you, but it does remind me a little bit of Open Table, if you remember that one. Mm-hmm. It's more like network effect business model. Like you said, OpenTable used to charge per head for that reservation, and got acquired by Booking. So I think, the thing is the liquor business is highly fragmented, kind of like the trucking business, I believe. And you've got a lot of local distributors and that sort of thing. They may not be as tech savvy, and so I think this may be a good play in terms of bringing that network effect. If they can get a lot of people to sign up for this and then bring it to the liquor stores, and they maybe hire an employee to go drive it over to them. I guess I can see it making more sense from that angle.
Yeah, it's certainly much better for the liquor stores that were using Drizzly prior to this. Now they have access to just people buying through the Uber app, which is, they have God knows how much more people on the Uber app than they do the Drizzly app.
Right.
There was one thing I also wanted to note here is that Drizzly is a holding company that owns Drizzly, the alcohol company, and they also own Lantern, which is a cannabis delivery company.
I was going to say that. They're also trying to deliver marijuana as well.
Okay, so that was my question. I didn't have that answered. If this money, do they buy both?
Expands the TAM, right?
Yeah, of course.
But I think it was in 2 states. I want to say, I can't remember. I read in the article. I can't remember which states it was, but they're in 2 states right now trying to do that.
I think Washington is one of them. I think they do delivery, but I don't know the other. So exciting for Uber. They are expanding that TAM, being able to deliver more and more stuff. They just made the announcement in the 4th quarter that they were going to build out their parcel network, Uber Connect. So now we've got parcels, we've got alcohol, we've got weed potentially.
The CNBC anchor too made a good point. She was like, "This is like a parent's worst dream," and it's like,
Yes.
And she was asking, can you get your weed and your alcohol delivered in the same shipment? And so it'll be interesting to see where this goes.
Yeah, a lot going on at Uber. Okay, let's move on to a story that we have from FreightWaves. This is on the ocean carriers. They are blanking sailings right now. Typically in this time of the year, they do blank sailings during the Lunar New Year or leading up to the Lunar New Year because of a lack of demand, or they try to pull some capacity off of the market to keep their rates in line. But that's not what's going on here. Ocean carriers are blanking sailings not due to a lack of demand, but due to port congestion. Seth, you care or not?
Definitely care on this one. And, we cover a lot of this stuff in Passport, and we were actually in our trucking markets report this morning. Mike Bowdendistel, who's on our team, was talking about something that relates to this, which is if you look at OTVI in the port cities, it's been growing a lot faster than sort of in the Midwest in particular, which was the big down market this week. And not only is it's actually spread from LA, given the port congestion and the problem with COVID dock workers, it's spread to secondary markets. And Hapag-Lloyd, I don't know how to pronounce that.
Yeah, close enough for me.
Close enough. They actually put out a document that Tony Mulvey, who works with us, was sharing, and it basically had all this data showing that it's spread to both the East Coast and West Coast ports and even New Orleans. Outbound tender volumes in New Orleans were up like 16% last week for a down week. So a lot of that makes sense. I mean, this story just continues to go on and on. It's amazing, and it goes back to all those things that we've talked about, which is you're still seeing this booming, and we see it every week in the consumer spending data. I mean, both non-durable and durable goods spending data just continues to boom, and it's expanded categories, right? It's expanded to clothing and some of these other areas that were really weak due to the stimulus. That's now picking up as well. So it's just fueling the fire, and they're out of ships, and they're out of containers, and they're out of dock space, and they're out of workers, and so it just continues. I mean, I guess in the good news for the freight markets is this kind of just continues to build that backlog in terms of the market staying strong over the next 3, 6, 9 months.
Yeah, agreed. This does push the peak even further. They keep extending the peak. They said the ocean carriers believed that the peak rates were going to be in Golden Week in October, and they missed that. They blew right through that. Then it was going to be the end of the year. Then they blew right through that. Now they're saying Lunar New Year, but we're likely going to blow right through that too, and keep rates and volumes high. Again, like you said, probably through the middle of the year. I love this line from Lars Jensen, the Sea Intelligence CEO. He said, "These are not pull-out capacity blank sailings. These are need to get back on schedule blank sailings." And as you said, there's no. So in this typical time when they see delays, they'll bring up recovery vessels to keep the lines moving steady. But right now they have no extra capacity. They are all running at capacity.
Right. So if you maybe I was going to ask you to talk about what the usual dynamics are and then what we're seeing right now. But yeah, basically, usually they have backup ships. So when all these ships, the core issue is all these ships and liners are stuck and literally waiting 10 to 14 days, I believe it said, at LA and Long Beach. And so they're just sitting in these parking spots or out in San Pedro Bay waiting, or even down in Huntington Beach and some of these areas. It's even spread to San Francisco. And so they're going all over the place. They're having to wait forever. The amount of like total lead time from, something going from China, for example, to the U.S. and hitting the retail shelves, it's off by 60 or 90 days. It's been extended by that. So there's all sorts of after effects in terms of, we may start to see bare shelves in terms of and undersupplied certain categories that are hot because there's all sorts of after effects that we can talk about. But yeah, why don't you touch on that real quick? Why do they usually cancel sailings, and why are they doing it right now?
Yeah, so the ocean carriers, maybe more than any other mode of transport, are really good at adding and taking out capacity just to make sure they maintain rates. So, even when demand plummeted even when demand plummeted early last year, they were able to maintain rates fairly well, given the fact that they just pulled a bunch of capacity off. They blanked sailings. We remember talking about that in January, February, March, that they were blanking 20, 30 sailings a week, and they were able to control capacity to meet demand to keep rates high.
It's better concentrated market share, whereas in trucking, you can't pull all those trucks off the road to support rates like in a 2019 period, right?
Right, precisely. And so in the addition, or the opposite happens when demand is high. We saw a lot of additional added sailings to make sure they're usually smaller vessels that can keep the lanes moving, especially from the China to the east or to the west coast, which is what we've seen, which is what they would be doing now if there were any more ships available. But there's literally, Hapag-Lloyd had said that they are max capacity. They wanted to make sure they came out and told people that they were canceling sailings, and they said that this is not because we're idling ships. It's because we physically don't have any.
They were like, don't blame us.
Yeah, not our fault.
It's messed up. It's messed up out there.
Yeah, and you are right. It is spreading. I saw that the Port of Houston had its largest container growth, biggest month ever in December. Same thing for Savannah. I mean, it's spreading to every port all over the country just about.
The one interesting thing, though, that maybe we can wrap up this part of the discussion on is Greg Miller in this article, he talked about at the end, and I think it was called Ocean Container X, or something to do with the containers. So there's several issues at play here, but one of those is actual containers, and one of them is ships.
Yes.
But on the container front, things appear to be easing just a little bit. There may be some light at the end of the tunnel based on that data that he was showing. I believe it's the 20 and for the TEUs and the FEUs for dry cargo. The availability, they're manufacturing those like crazy, basically in China, to try to correct the supply and demand imbalance, and we're starting to see in their data, at least in February and March, it's still undersupplied, but it's coming back up to that threshold of undersupplied, and it's those high cubes, the 40-foot high cubes are still in massive undersupply. So,
well, that's good news to hear that they are at least see a light at the end of the tunnel.
So in other words, one portion on the container side appears to be sort of evening out in terms of like, because they're manufacturing so many of these, like you weren't having these containers being able to be returned because they were stuck at all these ports. So that part is clearing up a little bit.
Well, that is very good news for sure. All right, let's move on to UPS. They have some great news from their Q4 earnings. They reported revenue of just shy of $25 billion for the quarter at 24.9. That's a record for the company and was up 21% year over year. Seth, you care or not about UPS earnings?
Yep, definitely care on this one too, and just a great quarter from UPS. I have not listened to the call yet, but I did, looked at a lot of the headline numbers, and they just destroyed Wall Street consensus estimates. They came in at about 265, 270 on earnings. I believe the street was looking for 210. They had some big pension charges and one-time stuff that you had to remove out of there for the UPS freight deal with TFII. But overall take on the quarter was booming parcel volumes. They've been raising prices, which has come with better margins, and they've had this really beneficial mix shift. So how the shift from services to goods has really benefited trucking and freight overall, but UPS has had a beneficial mix shift within that of their own to these smaller and medium-sized merchants where they have more pricing power and they've been able to raise prices. So that's flowing through both to revenue and margins. So really strong quarter. I mean, 21% revenue growth at UPS's size is absolutely enormous. So, and I think the stock had traded off a lot going into that quarter. So good to see, and a really good quarter, which I think overall just kind of suggests that there may be more legs. Similar to how we talk about this a lot with the trucking market, how long can these boom conditions last? I think UPS kind of answered that it can go on, for at least a little while longer here.
Yeah, I want to touch on a couple of the things you said. I do agree. I do care about this one. You mentioned about the mix shift to smaller shippers. They had volume up 28% for their smallest cohort and their largest cohort, which, the Amazon, or I don't think Amazon is actually in this one because of their direct partnership, but the Targets, the Walmarts, the biggest guys' volume was only up 4%.
Right,
year
so
over
that's
year.
huge for margins.
And then on the Amazon side, I thought this was interesting. I mentioned to you that that Amazon revenue came in at 11.3 billion, and you said, yeah, it's about 10% of UPS revenue comes from Amazon. It's cranked up a little bit more to about 13%, but.
Well, that's just because Amazon's growing. So fast,
exactly.
right?
I think it was like they're gonna record earnings. I think this week they're probably gonna post 100 billion.
And they're probably going to be
sales.
spectacular as they usually are.
Yes, spectacular. And then on top of that, not only did UPS have incredible numbers, incredible revenue, but they had good service too. We talked about all the delays, and they were able to minimize a lot of those delays with the shipping volume limits they put on their biggest customers. But Satish Jindal told me, the president of ShipMatrix, told me that UPS performed in line with historical averages for this holiday season. So despite the 20% additional volume, despite all the capacity constraints and everything, they performed really well.
I agree, and that's good to see. It seems like they've kind of learned their lesson from a few years ago, and they did a lot of planning and a lot of, they had a lot better insights into their network, and were able to plan for it, which results in happy customers. And you can't raise prices, by the way, when you don't have good service metrics. So
Exactly. All right, so we got two space companies coming up here, or two space stories rather. The first one is we've got another space company going public via SPAC, of course. Northern California-based Astra Space intends to be the first maker of small rockets to go public in the U.S. Seth, you care or not about Astra Space?
I don't care on this one. There's just too many space names for me to keep up with. So I get it. I would say this. I get it. Like, we interviewed back in FreightWaves Space Day.
FreightWaves, yeah.
Space Race back in the day. We brought in Bank of America's space analyst, and it's an attractive story. It kind of reminds me of the internet back in like the late '80s or the early '90s. Like you've got this massive forefront. So I am interested in the sense that I think it's going to be like $1 trillion market that triples in a few years, and so right now you're sort of in the pioneering days.
Yes.
Trying to figure out who's going to be that Amazon, who's going to be that Walmart in this space, because it's going to be, whoever it is going to be very valuable. And then, you've got all these different areas that where different people are playing, from space tourism to commercial space to all these different things. So I am watching it, but for this particular company, the most interesting thing is that I believe that Craig McCall, who is a former wireless billionaire and expert, he does lend some sort of expertise that makes me a little bit more interested, but I'm not interested in investing in this company. But I guess I'll watch it.
You don't want to be in another company with a $1 trillion TAM and no revenue for 5 years?
Yeah, I'm full up on those for the
There's
time
a lot
being,
of them these days.
and they keep on coming. That I'm experiencing a little bit of fatigue with all these SPACs. So there's just not everybody can go from 0 to 5 billion in revenue in 2 years.
Yeah, we talked about that just before this. You said if every company that is going public via SPAC got to 5 billion in revenue, the U.S. GDP would be growing at 20% a year.
Yeah, exactly. I mean,
like
that was somewhat of an exaggeration, but I think we're starting to get there. You're talking about, like, in the stats that I see every week. You and I read this Renaissance, who is like the king of IPOs. We read this email every week, and I'm just like, it's just jaw dropping. It's like SPACs in the latest month and quarter are like 200, and last year they were 2.
Yep.
And you just have to wonder at some point. Like, a lot of these are led by very reputable founders. They've got good balance sheets after these deals. But at some point, I mean, you've got hundreds of companies trying to tackle space and electric vehicles and all this. Not every one of them can be a huge winner.
Yes, you're right. I will say, for this particular niche that this company is going in. There's going to be more than one winner. SpaceX is by far the leader here, but Boeing is just behind them when it comes to taking rockets and taking satellites to space. But I'll be honest, I didn't know much about this company before I found them and wanted to put them in the show today. Once I did a little research, I did get more interested again because of reputable founders. So the founder is the former CTO of NASA, was the first CTO of NASA that was focused on IT. They've got, again, McCall behind them that's going to give them some telecom expertise. That's obviously going to be their focus, is taking up rockets or taking up satellites. The other thing I liked is that they're making really small rockets that are highly reusable and are going to be going up on a much faster cadence. They're going to go for weekly launches to begin with, but eventually get to a point where they do daily launches. Like SpaceX will never get to daily launches because their rockets are just too damn big.
Right, and on the other hand, though, and I'm not an expert on this, neither are you, but the thing that makes me a little bit nervous is I think they raised like $2 billion in cash, but they plan to launch a rocket weekly and spend $3.5 million on each rocket. If they start to actually do that without revenue, you can see why this is just not an investment.
Cash burner, yeah, incinerator. Certainly. All right, let's go to another space story here. This one's on SpaceX. So they just announced that they're going to do the world's first all-civilian mission. So they're going to launch 4 private individuals on a Crew Dragon capsule into orbit around Earth later this year. It's supposed to be about 2 to 4 days, the trip, but 4 complete civilians. Seth, what do you think? You care or not?
I do care because you and I have talked a lot about Virgin Galactic. We did an interview on it. Funny enough, and maybe it's some of the Wall Street Bets crew, which we're not going to beat a dead horse on that, but they've taken Virgin Galactic vertical on this news. Mm-hmm. And Virgin Galactic actually made an announcement that they had a little bit of a setback in terms of their first commercial launch before they get Richard Branson up there. But I think it's just supportive. I care in the sense that it's supportive for the overall space tourism industry, and it kind of shows it's the real deal, and it's kind of coming closer than you think because they're talking about launching 4 people up there with Dr. Isaac. What
is his name? Jared Isaacman is his name.
So they're going to take 4 people, and this is orbital space, by the way. It's a little bit different, which means basically you're rotating at a very high speeds around the Earth up there. So I do think it's cool, and if they're able to hit this target, SpaceX's valuation is already massive. It's between 50 or 100 billion. I can't remember the exact number.
Yeah, I think it was at 50 at the beginning of the year and 100 at the end of the year.
Yeah, things move fast these days.
Yes, they do.
But yeah, I do think that it's just another sort of signal that this is actually going to happen, and it may be closer than we think.
Yeah, agreed. I think that's a good way to put it. I definitely care about this one as well. 2 of the spots are actually still open we don't know who's going to be in them. They are open to the public, so you can go on inspiration4.com and apply for the competition. You got to give a donation to St. Jude. I'll be doing that this afternoon. Sorry if I got to take what it'll be a 4-month break to go to space at some time later in the year. That'd be fun. So yeah, I care about this one. I'm with you. I think it brings it closer to fruition.
Reality,
Yeah. For sure. Let's skip our 6th one here and just go ahead into our conversation on trucking stocks, where we think has it peaked for this cycle. Basco Majors seems to think a lot of them have. Why don't you go through and just give a little high level of his thesis, and then we can get into some of the details.
Last week, Bascom works at Susquehanna, and he covers the sort of surface transportation space. He covers the truckload, the brokers, the rails, the intermodal, all those names. I tend to agree with almost everything he said here in his note. And he downgraded a ton of trucking stocks. I've actually, there's sort of a growing chorus out there. I hate to be the bearer of bad news, but I do think that I don't think it means anything more than first half of 2021 may be as good as it's going to get for a while in trucking. And it doesn't mean it has to crash back down and be like 2019 again, but it just may not be that good. We saw spot rates peak out at $3.22 a month ago. You're looking at double-digit contract rate inflation across the board. Knight-Swift thinks it might be even higher than that. And then you've got sort of this, there's lots of stuff that we can continue to get into, but the trucking stocks and asset-heavy stocks are early cycle, right? You want to own them early because they have the most deleverage in a downturn, and then when things pick back up and get a little bit better, they start to grow their revenue fast and they grow their profits at a much bigger multiple than their revenues because they're levering all those fixed costs as things start to get better. So all Bascome is saying here is he thinks that the truckload stocks and then the spot levered brokers, which also makes sense to me, are not where you want to park your money if you're a transportation investor, because the same for the spot levered brokers. If as spot has come down, we look at truckstop.com here at FreightWaves, it got up to 322 a month ago. It's now down to 270. It's down 50 cents or about 16%, but that is revenue that comes right out of their back pockets if you're doing a spot transaction, right? Because you're charging spot.
Yep.
And yeah, so that makes sense to me. And he prefers some of the intermodal names and some of the later cycle names, which all in all makes sense to me.
So you mentioned there that you talked about asset heavy when it was the best time to get in there. That's early cycle. They have the chance to delever and rise higher. What about asset light? Let's talk, philosophically about the cycle. We've written a paper on this back at the beginning of last year, or hell, that was 2019 now.
Yeah.
2020 flew by, but we wrote a paper on brokerage cycles and trading in. Tell me a little bit about just the brokerage cycle.
Yeah, I mean, so the brokers, I mean, this was prior to a lot of this digital freight matching money flowing in from the Ubers and the Convoys of the world, but they were known, particularly 3PLs that did a lot of managed transportation, right? That had contract-based revenue, and a lot of the ones, if you look at C.H. Robinson and Echo and some of those, they tend to run. It varies depending on where they are in the cycle, and they like to get sort of strategic because it can really squeeze you when spot rates are moving up fast. But the basic notion is, for companies that get a majority, brokers that get a majority of their revenue from contracts, right? So early in the cycle, you'll see massive spot rate inflation, which we've seen now, where spot's been running up 50% year over year, and that happens. That's the purchase cost of transportation for these brokers, and that's occurring before they have time to go back to their shipper customers and raise rates on them. So they're getting squeezed on their margins, and that, while that's a negative early in the cycle, it comes back to help them. It pads their financials, it pads their income statement on the other side. When things start to cool off and spot starts to come back down like it is now, that now may be a great time because they may have been charging, just take a simple example, let's say they were charging $2 or $2.50 a mile to their shipping customers. They're probably going to come in and raise that to $2.50 or $3, right? Mm-hmm. And given the fact that that spot, which is their cost of their purchase transportation, is falling at the same time, they may have good load demand. They may get good price per load because they've raised those prices to their customers while their purchase costs are coming down. So their earnings are going to grow much faster. And so you've got this rotation effect in terms of money, where all the truckload guys, you wanted to get in there early because they have spot revenue and they're about to raise their contract. It's the next stage of the cycle in transportation investing.
You're telling me that carriers shouldn't be mad at brokerages for squeezing them when spot rates are coming down, because they get squeezed when spot rates are going up.
Correct.
Because that's what it seems always happens.
Yeah. Although it's a little bit like the Wall Street bets squeezing. There's a lot of misinformation on both sides that kind of gets emotionally thrown out there. But yes, I mean, if you look at the brokers, for example, I mean, their gross margins, right? Their gross net revenue or gross margins. It's a little confusing why you call it gross margins and net revenue, but they got crushed. So a lot of them, they used to average 15, 16%. A lot of those got down in even the high single digits or the low teens. And you're finally starting to, like C.H. Robinson reported last week, they had their first sequential rise in gross margin. And I think it was many quarters. So you're starting to see this sort of beneficial cycle for the brokers start to play out a little bit.
All right. Well, that is unfortunately all the time we have today. So Seth, you want to give a filler for your team? What's going on at Passport this week? You guys got your meeting coming up on Friday. What are you guys going to cover?
Well, we always do our trucking markets report, which we just put out today. We do intermodal on Wednesday, and we got our new rail and intermodal market expert, Mike Bowdendistel, joined our team, so that's going to be a really good report. And then Thursday, we're covering earnings season because last week we did TFI and UPS Freight, so we're going to do a big sort of deep dive across all these different modes and look at earnings season.
Interesting. All right. So anybody that wants access to Point of Sale, which is the newsletter I write twice weekly for consumer and retail freight, you can go sign up for that at freightwaves.com/POS. Comes out on Mondays and Thursdays. We will be back next week, this time at 3 p.m. on Tuesdays. If you guys want access to all of our shows, you can always find everything FreightWaves shows on demand at FreightWaves TV on the app. You can always find everything we have here at your favorite podcast player. Simply subscribe to Freightcast on Apple Podcast, Spotify, or wherever you listen to podcasts. Thanks for joining us this week. We will see you again next week. This has been Great Quarter Guys, episode 58. See you then.